Man, lo-fi is killing it today. I feel like lo-fi is a little bit less lo-fi in 2023. Maybe like lo-fi with occasional changes of synth waves, rocking some 80s stuff. Love it. It's with regret that I move lo-fi to the audience. She'll be back. So yeah, we'll get started here. It's 3 after. I suspect we might have some more people showing up here, but we'll go ahead and get started. So yeah, posted the agenda in the general channel and the tokenomics channel. We're gonna do kind of the usual stuff here, and then we also have some special guests today. Charles and Oliver from Future are kind enough to join us. We'll be hearing from them about their project as well. So yeah, hi-fi girl. So hope everybody's having a good week. Believe it or not, we're only 1 month out from the start of ETH Denver. Biddle Week starts on February 24th. So if you've made plans to come out, hell yeah, can't wait to see you. We're gonna have a good contingent of foxes here, just like last year. It's gonna be awesome. The event itself, the proper conference, kind of post Biddle Week, kicks off on the 2nd. So I'll go through the 2nd through the 5th. But yeah, every year has had a different sort of vibe and character. Last year was really, it felt like the year where everything was starting to go mainstream. We had over 10,000 people here. A lot of NFT excitement, I think, because NFTs were really reaching the mainstream. And of course, we were still kind of at the tail end of a bull market. But the cool thing about ETH Denver is it's very independent and sort of, I should say, like unrelated to price. You can come out, and I guarantee you won't hear many price discussions. People are focusing on biddling and the tech, and there's a confidence that the price of ETH, will eventually follow, or whatever other protocols. It's all about adoption and building, doing cool shit. In a similar fashion, I think that could be said with the price of Fox as well. Of course, here in tokenomics, we don't obsess over the day-to-day price of Fox, but it's more about ensuring that the DAO is in a good place to add value and reasons why one would want to own that token, ensuring that the DAO can survive the bear market, find a lasting product market fit. So along those lines, The tokenomics Q1, Q2 proposal was officially passed on Sunday. That was by a margin of about 20 million votes to about 1 million votes. So it's cool to have that formally approved. Thank you to everybody who voted, and also to everybody who participated in the related discussions in the forum. As always, good governance discussions. If you voted against the work stream, well, on one hand, you're stuck with this for another half year, but on the other hand, as always, the work stream exists to serve the overall community. So if you have any constructive criticism, feedback, thoughts, the work stream is always, myself and anybody working on this stuff in an unofficial capacity, always open for discussions in the public tokenomics channel, DMs. Yeah, the focus moving forward will continue to be encouraging the community to take steps to preserve its financial viability through the bear market. The key thing we will look at that, of course, or the key measure of that being the runway denominated in stable coins. Of course, there's other factors as well. The underlying foundation for all of this remains maximal transparency. I like to tell people, and I really believe this, of course I'm biased, but I think that ShapeShift does transparency better than any other DAO. Maybe there's some other DAOs that do it just as well, but through both our public discussions, which includes the Treasury Management and Diversification Committee, and of course the governance process, and also the dashboards we have, which leverage our on-chain data to present all the information in a more granular but also easy to understand fashion. I think it's state of the art. My hope is that what we're doing here with respect to financial transparency can actually serve as a motivating force for other projects, and also serve as a wonderful example to crypto skeptics of, hey, this is the complete antithesis of the clusterfuck that was FTX and all that stuff. SBF could not have gotten away with this if everything was on chain like we have. So in that sense, we truly are building the future. So that will continue to be a focus here in tokenomics. A related component that pardon me, that I listed is strategy. This, of course, overlaps with tokenomics, but it's part of, there's bigger, there's sort of meta components as well, I should say. This is kind of an outgrowth of the strategy session I led at the DAO retreat. Very excited to continue to push those discussions forward. And really with an eye towards ensuring that the DAO is still focused on bigger picture questions, and not getting too down in the weeds as we move forward and, say, implement the current roadmap, product roadmap that was approved. There's also a number of kind of diverging perspectives on some various issues within the DAO, and it's very important to have a forum where those can be addressed kind of on an ongoing basis. So tomorrow we have a strategy session that I'm going to lead at 3:30 Mountain Time. We'll be digging into a few of these things. One element will be a continuation of the SWOT analysis discussion we started at the DAO retreat, and specifically highlighting some elements, some dynamics that could impact the DAO moving forward. Opportunities, threats, things like that. And then we'll also hear some various perspectives, concerns as well. And again, I think this is just such a crucial aspect of ensuring that the community remains engaged, and also that that these various perspectives are taken into account. And hopefully the DAO can iterate on this over time. And I believe that with so many smart people working on this project, as long as we do it right and integrate a lot of those perspectives and have discussions, constructive, respectful debate, we're going to emerge in a much stronger position. Let's see. In terms of the runway, let me post that to the chat. Okay. So no major updates here. You'll recall last week we talked about the kind of factoring in infrastructure expenses, which were previously the purview of the Fox Foundation. These have been shifted over to the DAO, and they're the TLDR is it's essentially adding about 25K a month, roughly, to the DAO's budget or spend every month. So we factor that in. And then the other thing that's going on right now that's interesting is we have a number of proposals going back and forth through the governance process. So tokenomics is one example. Of course, there's no direct impact salary-wise on the runway, as I will be taking all 100% time locked Fox for another half year, and that's locked for a year. However, there is a one-time transfer of about 18,000 USDC to the tokenomics workstream for operating expenses. So I've factored that into the runway. Things I have not factored in yet are changes to proposals that are currently working their way through the governance process. So this would include globalization, ops, and marketing, all of which are in that process right now. I do not factor in anything before it's actually formally approved, because that, of course, that's sort of the law of the land here. It's governance approval. Of course, one can always make projections, but where we're at right now and what's currently incorporated into the runway and what you see is pretty close, I think, depending on how things shake out with the various proposals. These will not deviate super far from, I think, what's already in there, but just know that things will change, and there will be a little bit of flux moving forward. In terms of where we stand right now, it's still about 10 to 11 months. Once we move into February here, we'll have a good 10 months into November, just barely into November at current levels. Again, as a reminder, the DAO is not currently taking any steps to preserve or extend the runway, as our bond protocol offerings have been paused. The current plan with the TMDC that most members or all members seem to be amenable with is to reevaluate this and perhaps turn those bonds back on when the runway is down to about 9 months here. So the TMDC will basically be reassessing conditions and how things look in another month or so, continuing to keep an eye on this, and of course continuing to meet twice a week. But again, the goal is to ensure that we don't get into a situation where, my God, now it's down to 6 months and things like that. Another thing to keep in mind is that the bond protocol offering was, I think, in many measures very successful, and at least in terms of its goal of diversifying into LUSD from Fox. But there are other avenues to achieve that diversification as well. Arbor was a great example. That longer term offering was completed a few weeks ago and provided the DAO with over 90K of USDC. And that tool could be available again depending on market conditions. Of course, we don't want to assume anything, but we'll certainly be looking at going, maybe repeating that with Arbor. And then another thing to keep in mind is, I did some initial modeling here in the second tab of the spreadsheet where you see stablecoins plus 50K a month. So, of course, there's nothing for January. There likely won't be anything for February. But when I say 50K a month, this is just modeling out both stable coins as well as revenue that could help offset our expenses. So the DAO is not necessarily pre-revenue. It's sort of minimal revenue. We had $5,000 of revenue in December. However, moving forward, there's a lot of potential avenues by which the DAO could start actually earning revenue and offsetting those expenses. So it would be my expectation that via a combination of both revenue and diversifying into stable coins, that the DAO would be able to offset expenses moving forward and thereby extend the runway. I mentioned a few weeks ago that or maybe it was last week, it's all a blur in crypto, that a good goal to have for a runway, at least an educated guess goal, would be something on the order of 15 to 16 months. This is just looking at the history of the last bear market and how long it lasted. As much fun as it is to be enjoying this recent sort of bounce in crypto prices, this did also happen in 2019. I think ETH did a 3x before reversing course and testing those lows again. There are plenty of macro headwinds right now. The Fed remains hostile to sort of the risk-on environment. There still is inflation, even though I think the rate tightening will ease somewhat. But those conditions are very different than the last bear market. Of course, we still have a war in Europe. People are dying every day. There's a lot of uncertainty there. And the economy itself appears to be entering a recession, which, this will be an interesting test with all these challenges for crypto. That said, perhaps the bottom minute is in and we go a lot higher from here and don't retest those lows. But as always, we don't want to make any assumptions about market direction. And yeah, if one interesting thing to always check is the budget for subsequent months. This is in separate tabs. I have one right now for February, March, and this is just basically I factor in the latest estimates per work stream based on what I'm hearing from the work stream leaders, and also, of course, as various governance proposals impact that number. But you can see how those numbers are there, and again, those tend to flux on maybe a month-to-month basis as different things change. So yeah, that's kind of the big picture for that stuff. I'll pause for a minute to take a drink, and does anybody have any thoughts or questions? As always, if you have any, if you want to chat, jump up on stage or let us know in the stage chat. Cool. Well, great. Yeah, the main meat of the stuff we usually talk about, we didn't actually have too much today, which is fine because we actually have ample time for our guests today. So recently there was a forum post in the governance forum talking about potentially the DAO using 30% of its stablecoin reserves, putting that into a yield generating mechanism called Future, which would potentially then be able to generate, say, something on the order of 15 to 20K of USDC for the DAO every year. I let that team know that it's unlikely that the TMDC would be okay with this, just because it views the stable coin as sort of sacred capital that's the DAO needs to count on no matter what. Thus, subjecting that capital to any amount of risk is a non-starter. In fact, even stablecoin systemic risks and smart contract risks is something to be mindful of. So with that in mind, there has been an effort to actually move off of only having USDC. Now we have LUSDC as well, at least over maybe a month's worth of that. And of course, that's because for all of USDC's stability, there are centralized blacklisting risks there. On the same token, LUSD arguably has more smart contract risks. So it's always good to balance these out. But the bottom line is those are sort of sacred in a way, not to touch those. However, I let them know that as always, ShapeShift is interested in hearing more about platforms, both with an eye towards potentially integrating things. We always are interested in potential integrations, and B, there could be also opportunities around yieldies in particular. Maybe Foxy, depending on how the thing works, but certainly with yieldy, like USDC yieldy, which is not live yet, but the components are there. So Charles and Oliver have been kind enough to to join us today. Charles, I know you'll be on stage. Oliver, raise your hand as well if you'd like to jump up. Cool. Get you guys up here.
Hey, great to be here.
All right. How you guys doing today?
Hey, doing really good. Thank you. Thanks for making the time and thanks for having us on. Really appreciate that.
Yeah, the chatter about ETH Denver kind of hit a spot. We were there last year. We ended up getting COVID with everybody else, and we were sick for like a month afterward. So hopefully you guys don't have that this year.
Amen to that. Yeah, we were calling it Buffacron instead of Omicron. I actually came down with something. It wasn't COVID, but man, I felt like ass for 2 weeks. It seems like everybody either got COVID or something else. So fingers crossed that we won't have a repeat. That said, are you guys planning on making it out again this year?
You know what? We're really tied up. We're about to release a new product. So we've got to stay here, but I'm sure you'll enjoy it for us and send us an update.
Yeah, right on. And there's always live streams too.
There you go.
Well, yeah, thanks again for joining us. I know it's evening where you are, but really appreciate you guys, just kind of coming in and
Yep.
this is exactly the right way to, I think, approach a DAO like ours in terms of just kind of laying out what you guys are doing. And even though that initial, sort of thought is not is a non-starter, I think, yeah, there could be cool stuff moving forward. So if you guys wouldn't mind just quick intros,
Sure.
and maybe just an overview of future and all that good stuff.
Absolutely. I'll kick it off. So my name's Charles. I'm the growth lead and co-founder of Future. I'm joined by Oliver, who's product lead and my fellow co-founder as well. I'll start with the backgrounds of Future, a issue we faced, and then how USV came to be. I think that kind of sets the tone. So Future is a decentralized protocol that gives users exposure or passive exposure to crypto assets. So what we do is we create on-chain index funds and structured products so anyone can get exposure to crypto without the complexity of managing each asset individually. So our indexes are built with what we believe to be best-in-class methodologies. We rebalance monthly and we optimize for yield. So the current product range covers DeFi with the Future DeFi Index, which is PDI, Avalanche with the Colony Avalanche Index, Kai, and the USDC Savings Vault, USV, which is powered by Notional, which I can kind of share a bit about today. I'd recommend you check out the other products as well. They're really neat, and we love feedback as well if you check out the application. So let me take you back a year. We had a big problem. Our problem was, what do we do with our treasury? We raised a seed round back in 21. We wanted to get our money working for us. We wanted to take little to no risk. What do we do? So we went to AV. Back then it was 0.4, 0.5. I mean, today it's a little bit better. We then went to Compound, same kind of thing. So we ended up kind of using both of them. And we thought that was a good strategy. But the issue we faced was the yield wasn't really worth it. Because it being variable, it would change from 1% to 0.6 to 0.4. And for the risk that you're taking, it didn't really make sense. We didn't really feel comfortable with taking more risk than working with a recognized protocol. So we were trying to figure out our options. And that's where we came across Notional, which at the time had over $1 billion in TVL. They're publicly used by Yearn, and I'm sure many other kind of blue chip DeFi protocols use them as well. And what Notional Finance is a fixed rate lending and borrowing market. Very simple concept. People want to borrow at a fixed rate, and for that privilege, they pay a premium, and that's shared with the lender. So we started using Notional, but we ran into another problem. Notional has 3 different maturities, 3, 6, and 12 months. So when you deploy capital into, let's say, a 3-month maturity, and that maturity expires, you have to update it. Otherwise, you don't earn the premium yield that you're earning before. Now, this is really, really annoying because you have to make calendar alerts, you have to kind of remind yourself, and it really gets into the whole kind of treasury management thing. And when you're building a custom, when you want to make shit happen, as we say, it's a real pain to be doing that. It kind of makes it pointless. And that got us thinking, why don't we create a USDC savings vault, which rotates the capital into a 3 or 6 month bond automatically, thus earning yield or earning the premium yield and making sure DAOs, treasuries don't have to spend any time managing that as well. Now, this is a product that, and this is how kind of USV came to be. So USV is now the first USDC bond ETF with auto rolling maturities. The contract uses EIP 4626, tokenized vaults contract, which is used by Yearn, Alchemex, many others, very well recognized. It's been fully audited by PeckShield. USV is backed and redeemable for USDC at any given time, and has become our treasury solution. We put our money where our mouth is. It solved a massive problem for us. We feel it gives us the premium yields we've been looking for. I think it's currently 3.33%. And we're really happy with that. We don't take ridiculous risks. We get our yield coming in, and it removes all the stress and all the time that revolves around treasury management. As you guys know, it's a real time hurdle. We charge 0 fees for this product. Everything's open source, and that's USV. So if you have any questions or anything you want us to dig into, we're happy to dive in.
Yeah, I got some questions for sure, and thank you for that overview. So let's see, to clarify a few things. Okay, this functions in a similar fashion, basically, to an ETF, whereby an investor has diversified exposure to a number of assets. I guess two related questions here. What maybe just to use like PDI or one of your ETFs or index funds, what would be an example of the components in those? And then are these also, you mentioned kind of like rolling maturities. So this speaks more to like, bonds rather than just like, okay, you're investing in something over time and there's not really expiries. But what are the sources of yield in these various products?
Yeah, I think it's really good to kind of make a strong case for PDI and high, whereas USV is slightly different and has a completely different architecture. So with something like PDI, that has a methodology that looks for the top performing DeFi assets. And we have a methodology that we follow, which looks at volume. It looks at, has the token been around for a year? It looks at market cap, and then it will capture the top performing assets. So now we have Uni, Lido, AV Maker, Rocket Pool Curve, 1inch, and others. And essentially that rebalances every month following the methodology. We use Yearn to optimize for yield. With USV, it's different because we aren't rotating new assets in and out. So what we're looking at is the different maturities that are expiring. So if you have a 3-month maturity and a 6-month maturity, we're going to be rolling those over. So you're not having to then go in.
And what are the specific components of USV?
So let me dive into that. So with USV, when you look at what it holds, it'll either hold USDC, it'll hold a 3-month bond or a 6-month bond. We don't invest in the notional's 12-month bond because it has a 3-month period where it's not liquid and it cannot be sold. And so we strictly stick to the 3 and the 6 month. How does it work? Just a quick overview. We wanted to make it very gas efficient. So we've created this 2-step process for investing. So when you bring a USDC, you basically just transfer it into the vault. It's a really cheap execution. You transfer into the vault, and then we have basically a harvest function, which will harvest all of the USDC that's sitting in the vault, and it will invest it into the highest yielding maturity. So this is all automated. We have keeper networks that are basically looking at this function, and when it can be called, they call it, and they get rewarded for that. The contract will search for choose between the 3 and 6 month, whichever one is the highest yielding, and will allocate the capital to that maturity. If there is a maturity that's expired during this harvest function, we'll also roll that to the next available and eligible highest yielding maturity. So that's the kind of entry. And then on the exit, the reserve model works in our favor too. So if someone wants to withdraw USDC from the vault, the first place we check is the USDC that's been transferred in from depositors. So if there's any USDC there, and if there's enough to cover the withdrawal, we give that to the user first, which means that it's a really cheap withdrawal for them because they're just paying for a bit of accounting and the USDC transfer. And then we have some smart logic in the contracts that basically looks at and prefers to liquidate the lowest yielding maturities first and then the highest yielding maturities. That way we preserve the APR of the vault. So if we have a bond that's very close to its par value, not much yield left to get out of it, we will sell those first. And if that satisfies the redemption, then we don't sell anymore. And if we still need to withdraw more to satisfy the redemption, we'll then move over to the higher yielding bond. So that's like a waterfall structure for how we liquidate USV, and that just preserves the APR of the vault for everyone who's invested.
I see. So the constituent components of USV, you have you're actually you kind of using money Legos. You're building on the 3-month and 6-month notional bonds, but then using your own smart contract logic to abstract away the inconvenience of having to roll those over repeatedly.
Exactly, that's exactly right. So we're tokenizing exposure to continual exposure to 3 and 6 months. So it's essentially like investing into notional, but without selecting 3 or 6. You just select perpetual, and that's what we offer is a perpetual exposure. And the rates are at times 2 or 3 times more than the avian compound markets right now, probably double, or there's a 1% premium there. So and that kind of adds up over time.
Interesting. Going back to PDI, so this is actually an interesting contrast to Idle Finance, who the DAO recently partnered with. So Idle kind of seeks to provide, in a really easy way, provide users with basically getting the best yields that are out there. Whether it's the sources of yields could include for example, staking, beacon chain staking. They work with Lido, and there's other sources of yield out there. So they're kind of like aiming to provide, exposure to that. I think they have a diversification mechanism as well. But with PDI, it sounds like you're actually looking for, we're not talking about yield here. We're talking specifically about like the top DeFi assets and how they're performing. You rebalance every month. DeFi Cafe in the stage chat had a question, I think, pertaining to this, but it sounds like this is like an actively managed strategy based on either what you guys are looking at yourselves, your own analysis, or some sort of algorithmic analysis.
It's not actively managed; it's passively managed, and the methodology is set in stone. So it's nothing to do with what we find to be attractive or what's in vogue right now. Everything is run. We actually have on our GitHub a rebalancing data repo. Each month we post a script that we run through that essentially programmatically executes all of the points that we can execute programmatically of the methodology, and then spits out at the end a list of assets, and then any ones that we need to take some qualitative care over, we'll look at. So everything is run through our program, and it is publicly available. And so like Charles said, the ones that have a minimum time in the market of a year have minimum of $5 million for us to give our investors a broad exposure to DeFi, at least on Ethereum for now. So I think we have like 12 assets in there at the moment. We're just looking at rebalancing that in the next few days, and that'll add another 2 assets, bring us up to 14. So the way that we look at it is, we've had very good performance from the likes of Curve, Lido, Rocket Pool recently, and we're going to be adding FXS into the index and a few others. So it's growing continually, and this is in a bear market. I think in a bull market that could have double the assets that it has now.
Cool. And then will or could that rebalancing strategy change over time based on market conditions, or is this something you see as fairly set in stone, even amid the crazy volatility and rapidly changing investing landscape and volatility of crypto?
We really think that a stable methodology is so important for us to get trust and adoption that we want out of the product. So I've seen some models where they kind of use the DAO and people's ideas within the DAO to steer the way that they rebalance the index. But for us, it that tends to, in bull markets, favor getting assets into the index that maybe have just launched, that are doing really well, but they haven't passed any sort of Lindy test yet, and they haven't been in the market for a sufficient amount of time, things like that. So we really steer away from that. Things like whether we move from monthly to quarterly rebalancing as we mature, those are certainly things that are on the table. But as far as drastic changes to the methodology is not something that we're looking to do.
Awesome. And then in terms of like the
Next game, any fees you're paying, price impact you're paying, it affects your performance. And so we wanted to make sure that we had the absolute best execution we can get. So we pass everything through 0x to get the best swaps. And then those assets are transferred into the index, and you are transferred index tokens, which is representing your share of the index. If at any moment you want to redeem, in fact, even during rebalancing, which a lot of protocols will pause redemptions during rebalancing because it messes up their accounting. They've basically accounted for how many assets they have, and they've created orders to rebalance based on how many assets they have. So they kind of lock the assets in place until they're done. We actually enable people to redeem during rebalancing. Doesn't affect us. Our contracts can handle that. And so, when you redeem, you can redeem for constituents, which we don't expose because we think most people want to go back to ETH or USDC, but it is available in the contracts. Or, like I said, back to ETH or USDC. In addition to that, we've added yield-bearing vaults on top. So some of our assets, if you go to our application, you'll see they have a yield. And we've been tapping into Yearn for those assets. And we're looking to expand that range to tap into places like AV directly and Euler directly, because with Yearn, they typically support vaults or support assets that have multiple sources of yield. So, if we can support sort of things like AV and Euler, it gives us access to assets that just have, a single source of yield, which wouldn't get supported by Yearn. But we're the only index to really develop that as well. So you'll be able to generate, we're productive at least with the assets that we hold in the index.
Gotcha. So let's see here. In terms of the optionality, choosing to redeem for the components of the index or USDC, I agree. I think that most people would choose USDC, unless they really want to custody those various assets. That's a cool option too. But in terms of how that works, is it a case like, let's say that there are $10 million worth of assets in PDI, and somebody comes along and they want to redeem, maybe they have a good chunk of that fund. They want to redeem a full $1 million, 10% of the fund. Would you guys then basically sell the corresponding, 1/10 of those holdings on the open market to then generate that 1 million in USDC, or do you guys have like sort of a parallel holdings of like the appropriate, or like a mirrored amount of stable coins?
So in our current model, we will sell the 10% of each asset that is custodied by the index. It will sell that for whatever it is, whichever the user desires, and we'll transfer that back to their account. So that's how it works currently. But we have plans to, and we're already building this stuff in our next version to really allow, because you know what it is, right? When you mint or burn at the moment, we have 12 assets. Soon it's going to be 14. 14 swaps is very expensive. You're looking at, well, on a bad day, it's like 3 figures, right? So for gas. So we recognize that. We think that's a limitation. And we know that the value of our index scales linearly with the number of assets that we have. If we have 30 assets in the index, it's very hard for someone to replicate that portfolio. And so they'll just say, okay, I'll just buy PDI. And so we want to get to that place where we can support that many number of assets, but also keep the gas costs somewhat reasonable. So that's where, our reserve model that we have for USV, where, people are directly transferring USDC into the vault, rather than the alternative, which would be to transfer USDC, then go buy the 3 and 6 month bonds on notional. So we've taken something that might cost, $20, $30, $40, and it now costs, say, $10. And it also allows the redemption side, if there's USDC available, to be pulled. So it at the best case, it allows for cheap deposits and cheap withdrawals. We're going to bring a similar model to our indexes to allow people to have those cheap, basically to dislocate the price, the gas cost of investing into an index that has 30 plus assets. And that will allow more people to invest, which is what we want.
Cool. Let's talk about fees for a minute and how you guys make money or intend to make money. So if we were in hedge fund land, we'd probably be talking about the 2 and 20 model, and ETFs have various fees, whether they're actively managed or passively managed. Actively managed are usually more, because you're trusting some group of people to be super fucking smart and beat the market, which is quite difficult over time. But whereas you can do the set it and forget it Vanguard approach. But what is your guys' approach with respect to fees?
So with PDI, we have 3 different fees. We have a minting, which is 0.2, with a management fee, which is ongoing, which is 1%, and then a redemption fee of 0.5%. That's when obviously you redeem for the asset or the underlying, or for ETH or USDC. There's a fee that's going to come with that. What I think is important to note is that with the yield that we're going to be supporting and the additional assets we're going to support for the yield, the fees won't really come into it, because the APYs that you're going to be earning, in the next month or two are going to outweigh that significantly. So you're actually going to be making off the yield as well, not only covering your fees. So it becomes, in that respects, a free product to use.
In terms of the redemption fee, you said that was 0.5%?
0.5%, yeah.
Oh, 0.5. Okay. So that would be on the total that you're then redeeming for. So it's kind of like a very, I mean, the analog would be like a performance fee, but this is quite small compared to, say, the 20% that a fund would charge.
Yeah, and the reality of it is it's also a tax on arbitrage, because we know that there's consistent arbitrage between what you get, what you can buy PDI on the exchange for, and the NAV price that we offer it on our platform. So a lot of the time, people who buy the index will sell it on the exchange, no problem. So that's their prerogative. They can go that way if they'd like. And a lot of the time, the people who are actively redeeming, unless they're doing big size, which then would make sense for them to redeem, it's often arbitrage flow. So, that's also acts as a tax on arbitrage flow, which happens consistently, and is something that, we make money off of over time. So those are the two approaches. And one of the things that we built into our app is a very easy system to buy, because you can buy it on the, like I said, you can buy it on the exchange, you can mint the index, or you can sell it, or you can redeem it. So there's different options available to people. But if you come to our app, we make all the decisions for you. We'll basically look at the exchange price, we'll look at the mint price, we'll calculate how much gas cost it will cost to go either way, and we'll present the best option to you. So it's very simple to get in and out of the product.
Nice. One of you mentioned Lindy. How much Lindy do you guys have? When did Future launch?
Oh, our first. I need to pull this up because it was many months ago now. Let me see when our
PDI dates back to about May.
May.
For PDI. Yeah, that's when we kind of started trading.
Nice. I think bear market's a great time to launch protocols. So many, look at how many successful ones came out of the last bear market.
For sure. What we've experienced is, when we entered the space, there was like a few different players, and then they've all left to do go into very competitive markets because they think they're going to go and get revenue there. And it becomes quite attractive, I think, when you are seeing others generating revenue of like leverage or yield to then join the masses. But the thing is, when the market picks back up and these key areas that you've stayed and built upon come good, you now don't have an edge in those areas if you don't stay there. If you're just constantly moving to like the next big thing, you're never really going to grow a big thing yourselves. So it's been great for us to stay here and stand up and say, we are the index guys and we're building. We have a wonderful cross-chain product coming out soon, which I can't speak too much about, but we're here and we're active.
Yeah, I'm glad you mentioned the cross-chain stuff, because it kind of touches on another question I had with scaling. You mentioned the high fees. It sounds like the current implementation is purely ETH mainnet, which makes sense because you're building on the notional money Lego. I'm not aware if they're on Arbitrum or anything yet, but it sounds like you guys have some cool sort of stealth mode cross-chain functionality. Is it accurate to say that you are building with an eye towards like a scalable future and towards a roll-up based future?
Yeah, it is accurate to say that we're looking at, okay, so gas prices on Ethereum have, for the most part, over the last 6 months, maybe plus, have been quite reasonable compared to what they have been, in bull markets. But I think that you could get lulled into a full sense of security. But let's just build on ETH mainnet for our next product, because that's like the place which has the most mind share and the most users still. But I think that when we pick back up, layer twos are going to have a huge influx of new users, and also, you know, yeah, there's a lot of cool stuff that we're building, which actually means that it won't really matter what chain where our logic is on. You'll be able to get our products wherever you are, So it doesn't really matter. The notion of like where is your logic held, will be kind of dislocated from where can you use our product, if that makes sense. There's some really cool stuff that we're working on that's going to enable that. So we can be on Arbitrum, but you can use us on Ethereum or Avalanche, and that'll be how it will work.
Sounds like you're speaking towards like addressing the challenge of like aggregated liquidity across different chains. I'm excited to see more about this sort of stuff. Are you targeting like sometime like Q2, Q3 is sort of perhaps a launch date for this new product?
Yes, I'd say conservative is Q2, but we're pushing hard, and we're making a lot of progress in Q1. So, but we want to make sure that obviously everything is fully tested, fully audited. So all that takes time. But yeah, end of Q1, start of Q2 is when we're targeting that, and I think it's going to be a big shift. It's going to be a bit all of the learnings that we've kind of accumulated over the last 6-7 months of operating live indexes, and all of the thought that we've has gone into V1, and where we can see the pitfalls of indexes, and how we can see that we can maximize our value by improving certain areas, making things cost effective, and just taking things to the next level in terms of how broad we can go, because the broader we can go, the more applicable we can become. So yeah, that's been the thinking on that front for the future.
Excellent. The cross-chain stuff is very near and dear to our hearts here at the DAO, because one of the things that we aim to do is make crypto easy across multiple chains. Say viewing your balance across multiple chains, and for ShapeShift is the notion that DeFi protocols can get more eyeballs and more users and more liquidity and revenue by virtue of plugging into ShapeShift, because we have a nice existing user base, and then kind of potentially the model there is maybe a rev share agreement. We're sending DeFi or users to the platform. This is kind of one of the things that we've been doing. So I think like the next steps for the DAO, at least from the treasury perspective, the TMDC, take a closer look at future as potentially just vetting that as maybe a yield source for Yieldies, which is our product designed to make you basically stake a USDC in a Yieldy contract, and then ShapeShift makes it easy to earn yield on that, because it's tapping into another source of yield or sources of yield. And then there's also the product side. Yeah, different paths forward. And again, like I feel like the bear market is a perfect time to be digging into this stuff, because the hype is down, the pressure of dealing with crazy amounts of money and growth isn't happening. That said, I want to open it up to the crowd for any potential questions here.
Ken, sorry. I think I just
Sorry, you cut out, Oliver. What's that?
Oh, I think he's gone.
I hate it when that happens.
Yeah, it's so annoying, especially when you're speaking. You think people are listening to you, and you come back, and they're like,
yeah.
"Did you hear me?" And then they're like, "No." You're like, "Oh no." Are you back?
can you hear me?
Hey,
Yeah,
there
I can
you
hear
go.
you now.
Yeah, sorry. I was just saying that as it pertains to Yieldies, one of the reasons why USV is a great option is that we don't charge any fees. You often find it's hard to stack fees and still provide a competitive experience. So like, let's say, with Yearn, the Yearn's got to take a fee, and then they've got to tap into all these different vaults, and they've got to take a fee. So you end up stacking the fee and hurting the returns. And then you kind of people might decide just to go direct to source. With USV, because there's no fees, it's a perfect product to stack within another product, because you don't have to worry about like diminished returns, or the users don't have to worry about diminished returns from too many fees being stacked into one product.
Oh, okay. So to clarify here, PDI has those fees for minting management and redemption, and USV has no related fees.
USV is completely free. Yeah.
Interesting. So you guys kind of view that currently maybe as a product to bring more people into the future ecosystem, and or maybe you have other thoughts on potentially how you guys might benefit from that. But that's like super interesting.
Yeah, I mean, for us, like we benefited from our own treasury, so we thought that, and we know that other people can benefit as well. So why put a hurdle on it and introduce fees when you can just go after the users and build it up organically and give people the value first? If we build up and grow the TVL on that product, we can take a view on it, but it's not really our goal right now. We have other products like PDI, Kai, and the cross-chain product we're going to bring out where we feel very confident about the revenue side.
That's cool. And what is like the prevailing rate right now? What kind of yield could you earn if you jump into USV at the moment?
It's about 3.33%. And the cool thing about that is, unlike a variable yield on an AV or a compound, it's dependable. It's not going to change drastically. You're not going to find out like 1% tomorrow. And I've experienced that many times, ourselves on AV or compound, when you think you're at 1% and then you check it again, it's 0.4. It's really frustrating. And with the current usage we're seeing with Notional's products, we're actually seeing that yield increasing. They have increasing as well. So it's very interesting, the flywheel effects taking place in the ecosystem, but USV is benefiting from them.
Yeah, it's a great point that Charles raises there with regards to the way that the return is distributed to you. So if you were to invest into USV today at 3.33%, and then the yield was to collapse down to 1%, the people that had invested when it was 3% lock in that rate. That's the cool thing. So it's just like a bond ETF, right? So if the yield goes up, the price of the bond will dip down, right? And then people can invest into the USV when the yield is high, and then when that yield collapses, the price of the product's going to go back up. So what will happen is you'll get an acceleration of the yield that you was going to earn over a year's period. Now happens much quicker because you locked in 3%. It's now at 1%, so the bond price has gone up and you locked that in, which is different to being on, say, compound and earning 3%. Then it goes down to 1%. What happens is the next marginal sort of like time interval, you're going to be now earning yield at a lower rate. So you don't lock anything in. With this case, if you lock in 3%, you'll get that. If the yield comes in quicker, that's just a benefit.
That's really interesting. So to maybe put it a different way, make sure I understand this correctly, holders of USV can kind of leverage the inverse relationship between bond yields and bond prices in a way that it sort of limits downside and manages risk, and it allows them to maintain a predictable yield.
Yes, if we do like a simple example, let's imagine the bond par value is $100, and it's currently trading at 97, right? You buy the index at 97, and you expect that over the next year you're going to earn those $3 extra, right? Now what could happen is in the next month that rate could collapse. We could go from 3% to 1%, and the bond will go from 97 to 99. So that maybe we should have been at 99 at, say, October, right? But now we're only a couple months into the year and we're already at 99 because you've locked in that rate at 3.33%. So it's a great way of kind of being a bit more secure and sure that if it says it's going to be 3.33%, you can lock that in for the duration of the bond.
And that the duration. So this is one thing I'm still unclear on. And yeah, we're actually bumping up against time here. I want to be respectful of your time, but the duration of the bond. So for somebody that purchases USV, is that for an actual fixed duration? Because you're rolling over between automatically between like 3 month and 6 month. But is it possible to just hold that bond for perpetuity essentially and enjoy the ability to earn a fixed yield?
On the USV side, when you invest in USV, it's like investing into a bond into perpetuity, but the underlying bonds obviously do expire. So USV is made up of a blend of 3 and 6 month bonds, depending on like which one has the highest rate at the time. We'll be investing into that one more, and so you lock in a rate for the duration of that bond. So if we have some 3 month bonds within the product, obviously when they expire, we then harvest that yield and move it to the next duration. So the longest time that we hold a bond for is 6 months. And so, we can, if we were to say invest everything into the 6 month bond at the very start of the period, you would lock in that rate for half a year. And then what we would do at the end of that period is we would roll to the next month, and then whatever the prevailing rate, in that next maturity that we were able to get access to, you would then lock that in for another 6 months. If we were, say, to just to keep it simple, to invest into one bond, but obviously we invest into a blend of 3 and 6. So we're locking some rates in for 3 months, we're locking some rates in for 6 months, and then the users get the blend.
Awesome. Yeah, there's something very sexy about fixed rates. This is bear market. We're talking about a sexy 3.3% yield, but I mean, fixed rate in DeFi was something that was really kind of unheard of during the last cycle, and it's I think it's a game changer, the ability to have that, both from a lending and borrowing perspective. It's really cool. We're actually almost at time here. Just really quickly, did anybody have any questions for the future dudes here? Cool. Well, hey guys, really appreciate you taking the time. Again, I think there's potential explorations on two fronts with ShapeShift, both the yieldies and then just kind of looking ahead on the product side. But thanks for kind of joining our community. If anybody wants to learn more about Future, it sounds like you guys are here on Discord, or would you prefer kind of being pinged here on Discord, or should they check out the site? It looks like you guys posted links in the stage chat.
Yeah, man, check out the site. You have our Discord link there. You have a Twitter link there, and you find us in Discord, always online. Welcome, join in. We'll follow up on both those points. I think they're very interesting. Really happy that we got on today's call, and thank you for the time and the opportunity to share more about our ecosystem.
Yeah, thanks for joining us, guys. I really appreciate it. Have a great rest of your evening.
Thank you. Thanks,
Cheers,
guys.
Bye.
Take care. Cool. So that was a great session. On Wednesday at 3:30 Mountain, and yeah, everybody, let's get Lo-Fi back up here. Some more sick beats. Everybody have a great rest of your day.